Seems like Goldman maybe got tired of all these private credit firms eating their lunch.
Well, there is a slight distinction between Goldman and the other banks. Unlike its most major competitors, Goldman already is a bit of a veteran in the niche of private credit. It has over $100 billion in assets. It wants to grow to $300 billion. But remember, the goal at Goldman Sachs right now is to really turbocharge its asset and wealth management division. It's money management business. And the best calling card when you're seeking an expansion in that space right now seems to be private credit, which undoubtedly is the buzziest and busiest asset class in Wall Street.
Well, it feels like we can't go into any conversation without talking about private credit somehow. Actually, we heard from JP Morgan Chase Chief Executive Officer Jamie Dimon saying on Wednesday that there's going to be hell to pay if private credit sours. What exactly did he mean by that?
Don't you love it? Wednesday morning, Goldman Sachs says it has raised its largest pool yet for private credit bets. A few hours later, JP Morgan, one of their top rivals, comes out and says, Jamie Dimon, no less, comes out and says there will be hell to pay. What he's really talking about is this deluge into the asset class. Yes, there are veteran players there, but you're getting into a credit asset class where credit selection is important. You are dealing with individual companies. You're not part of a broadly syndicated group where you have small tickets and a number of loans where even one or two defaults are not going to hurt you that much. When it's a single company, when you have most of that loan, a bad situation, an adverse economic reaction, an adverse market reaction to that company could cause you great pain. Yes, the veterans you can trust are able to find good deals. When there is some problem, figure out restructuring, figure out how to get out of that sticky situation. But for some of the newer entrants, we're not really sure if they're well equipped to tackle that. So when the credit cycle turns and a lot more players are in this private credit space, which has existed for a few decades but has really grown in the last few years, that could be cause for alarm, and that is what Dimon is talking about here.
And I only have about 1 minute left with you, but you touch on something that I've been wondering when it comes to private credit. Is there enough opportunity out there to actually deploy all this money, basically, that's coming into the asset class?
Historically, when we think about investments across asset class, and I'd go back to something Mark Rowan said in Apollo's earnings call. He talked about this idea that you think about 50% in the public equities market, 30% in fixed income, 20% in alternatives. All the growth that you've seen in the alternative space, he said, has been from that 20% bucket. What it looks like, with fewer and fewer public companies out there and that alternatives bucket growing, there definitely is a sense out there that that asset class will continue to grow. So yes, there will be more investors jumping into the space, but we're jumping into what feels like a growing market. So the sentiment, at least right now, is there are opportunities there. There is money to be made.